Real estate investment practice problem, use in Excel. Decision to purchase a home or rent calculation, new format, part number 5. Get ready because we're raising the stakes with real estate. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we have 4 tabs on down below: example, practice, blank, and the pivot table tab we made in the first presentation. Let's take a look at them now, starting with the example tab, in essence being an answer key. If we go all the way to the left, we've got our data on the left, which are going to be our assumptions on which we're going to do the rest of our calculations and have been doing in prior presentations. Starting with the amortization table, we then constructed the pivot table. Then we entered our data with regards to the loan summary on a horizontal basis. We looked at the property value increasing. We looked at the cash flow related to the property, not including a sale of the property, but the cash flows if a purchase took place, including the loan payments and maintenance and so on. We then took into consider the cash implications, which could be affected with regards to the home purchase for deductions. And then we looked at the net cash flow after taxes being taken into consideration. We then calculated the renting of the place, which was our starting point, meaning $24,000 currently going out for rent monthly, we are assuming. And if we purchased after the down payment, we would still have a net outflow in the first years, which then it flips in year 12. Then we looked at the cash flows related to the sales, assuming that we sold the property in each one of these years. So obviously the sale doesn't happen each year. We're looking at the cash flow as if we made a sale in any one of these years. And we looked at these items. We took a look if there was any tax implications, which there wasn't for most of the years, given the fact that we had a $250,000 exemption. We are assuming that gives us the net cash flow on the sale of the property. Now we're constructing this really neat table at the bottom. It's going to be reversed to what we did last time. It's a good Excel skill practice. And it's also a nice table to put together and consider what would happen if we were looking at the cash flow and the rate of return, assuming we made the sale in each of these years. It's reversed from what we looked at the prior practice problems. So in essence, we're assuming we sold it in year 1, 2, 3, and 4, and the totals are going to be on the right-hand side instead of down below. This is the table, another table, which I don't really like the format quite as much this way as the other way, but it lines up to the formats of the other tables we've looked at, which are more aesthetically appealing. Up top, typically, I kind of like the totals to be at the bottom and this kind of IRR calculation, but it works still very nicely. So we got the years here. So we got the cash outflows that we can see. For example, in year 6, we had the $80,000 deposit up front. That's going to be the same for every year. And then we've got the net outflow from the cash flow related to the home purchase versus the renting for year 1, year 2, year 3, year 4, year 5, and then we assume we sold it in year 6, having the net cash outflow and the proceeds from the sale. So if we look at that stream of cash flows, we can see the net cash flow that would be over here, 26,667, and we can see basically our rate of return on that cash flow, meaning we put the down payment up front and then the net outflows going forward. What would be basically, in essence, the return on that, calculated in essence our internal rate of return here at the 455. We assume that happening each year. So pretty neat table to put together. We're going to do that now. We got the practice tab, which has some pre-formatted worksheets, so you can work through these practice problems with a little less formatting involved. And then we got the blank tab, which is where we'll be working, putting this thing together from scratch. Same kind of scenario. We're over here in column T now, and we have the same information for the most part as the example tab. And then we're going to go all the way down and put this last table together, looking at the cash flows on a year by year, assuming we sold it. So we got this nice cash flow. So let's label it cash flow and internal rate of return. We're going to say that's the IRR calculation for per year, the IRR per year. Let's pick that up as our header. Make this dark blue again, as has been our custom, blue and white. Then we'll put our years down here, years. My fingers are on the wrong buttons. Years 0 tab, 1 tab, 2 tab. And then we'll take that and put our cursor on Phil's handle grab it, pull it all the way to the right for 30 years, make that black and white for the headers as has been our custom, and then we'll align it, centering it, make this black and white too. So then I'm going to have the years down below as well. 1, 2, or let's start, just start at 1, 2 instead of 0 this time. Now notice this is another kind of problem in a little bit, is that obviously this cell is kind of wide due to it being the description cells over here. Not too big of a problem. But when we only have years, it looks a little funny, as opposed to if we had the header, the columns and rows the opposite, as we did in the prior practice problem. Centering this, there we have it. So now we're going to say that these are the years downwards that we have the sales, and these are going to be the cash flows in each of those years. So first, we've got the net outflow for the down payment that we had. So up front at the beginning, in every circumstance, no matter when we sold, we put a down payment of $80,000 down. So I'm going to say F4 on the keyboard, and I'm just going to copy that $80,000 all the way down, because it's going to be the same for each year. And actually, I want to have it negative. Let's double click on it and put a negative. So there it is. Now let's copy it down, and I could just double click, and then it goes all the way down here. All right, and then we've got the years that we're going to have the outflows. Let's actually start down here somewhere in like year 10, so we can see what would happen if we sold it out here in year 10, and then we'll construct it back as if we sold it in prior years and years after that. So we're assuming we'll sell it in year 10. What would happen? Well, we put $80,000 down up front, and then we'd have the net difference between the cash flows equals, scrolling up top, that would be right here, because we were putting $24,000 down. If we made the home purchase, we'd still have a yearly outflow over and above that of $27,388. So the net difference in cash outflows after the initial investment of the $80,000 would be the $3,388. So we get the $3,388. Now I can copy that in essence across now to the year we sell. So I'm going to put my cursor on the fill handle, and it's going to pull the relative items over to year 10. So year 10 is the year we actually sold on. So if I double click here, I'm now picking up that 503, which is the difference in the flows, and now I have the sales amount, which is going to be this amount, assuming we realize the sale at this point. So I'm going to double click on this. I'm going to add to it this 178,866, and that gives us our 178,363. So that's it, because then there'll be nothing in year 11. So if I go all the way out to my totals, then if I total this up, now the totals are on this side, which again is kind of funny, but it works. We're going to say the sum of these, if I sum up my cash flow this way, not picking up, of course, the years over here, enter. So there's our net cash flow, and then the IRR equals the IRR, the internal rate of return. And this is a good calculation because it takes into consideration time value of money, would be these items. So there we have it, and we're going to make the IRR, making that percent and adding some decimals. So we got this 6.5% in year 10, 6.5%. So that would be it. Now we can take that information and adjust it to the rest of the years here. So we're now going to say, okay, let's try to do that same thing. Let's go upwards and then downward. But I'd like to be able to copy it up and down. So this one, I'd like it to be the same. It should be the same number as far out as basically this would be applicable. So in year 10, so I want to copy this one up all the way up to basically year 2, and then in year 1, we're going to have to assume the sale happened in year 1. So it'll look something like this. We're going to say, okay, how could I do that? If I double click on this one, it's pulling from this number. I basically want to be able to copy that up. So I'm going to move this cell up, but have this cell stay the same. So I don't want it to move up, but when I move it to the right, if I move it to the right, I want to be able to copy it to the right. So in other words, the numbers that go up and down are the number amount, and so that's the one I want to stay fixed. So I have a mixed reference, which is a $ before the number amount, and not the letter amount. So if I put a $sign there and say enter, I should be able to copy this one up, for example, still have it, and I could still copy this to the right, and it shouldn't mess anything up. So I'm going to copy this to the right now, just to now show that I got that mixed reference all the way across, and then I can copy this one up to the year 1, and so there we have that. So that looks pretty good. In year 1, if I assumed we sold it in year 1, I'd have that difference in the cash flow, which is coming from here in year 1, and I would have this amount if we sold it for the net cash flow. So I'd say plus this amount right here and enter. So there we have that. So now if I look at that in year 2, I'm going to do the same thing for year 2. Let's do this one right here. This one now has the proper formatting. If I copy that up, I only want to copy it up to year 2. And then if I assume I sold it in year 2 here, I then have this number that we have up top, plus I would need to add to it this number right here. So I'm going to say plus this number right here. So there we have that. Now this one, the W is correct. We have the correct mixed reference. If I want to copy this one down diagonally, which is the pattern we're going to look at, then what I'd like to happen is this one, I want it to move to the right, but again, I don't want it to move down. So I need a mixed reference here to a $sign before the number, which is the 61. So mixed reference, and that should allow me to copy this down. So what I'm going to do now is I'm going to take this item right here and copy it down diagonally. So copying this here, and that'll show that's picking up the right 2 numbers. And then I should be able to copy that down due to our mixed reference. It'll end up right there. You can see the diagonal pattern will continue. So I'm just going to copy that down, and that'll be like our stopping point for the red numbers. And I can redo this one, right? Same number. And I'll bring it all the way out to 30. So I'm just going to do the diagonal thing all the way out to 30. I'm just Control C all the way out. 30's way out there. Way out there. Over the rainbow. The rainbow always seems to be way out somewhere, apparently. If it was closer, you could get the pot of gold. And then once I hit 0, I must have gone past. So there's 30 right there. That looks good. And so now we'll fill in the rest of it, which I should be able to just basically copy these items up and then down. So I should be able to say I could copy these up to here. So there we go with that. Let's copy these up to that point. And that top number is correct. And we just fill this in. Easy peasy. It's not simple, it's easy, which is easier than ABC because it starts at E, then to Z. Then we double click here, and then we make it even simpler by going PZ, E to Z to PZ, which means then you're only going from P to Z, which is way less letters involved. So easy is easier than simple because it's E to Z instead of A, B, C. Oh, I don't know what I'm talking. Okay, we're going to copy this down. We're just copying this down, and we'll copy this down. And then we'll do the same thing here. I'm just going to copy these down diagonally. So this is a nice pattern that we'll look at. And it's going to be working because we have that mixed reference involved. This is where it flipped to a positive number, because remember, it's picking it up from here where it flipped on year 12. So now it's a positive number. That's fine. Now we got an inflow, a net inflow instead of an outflow. Just pasting these out diagonally, and then copying that down, and so on and so forth. And then we'll just go in and do our double clicking on the absolutes and just copy this pattern down to the bottom. And we got this nice calculation, which looks very confusing. But once we do it a couple times, not too bad. And then once we stare at it for hours and days on end, we could figure out what it might actually tell us something after our mind stops being confused from the interesting pattern that it's making here. So there we have it. I'm just talking because I don't want blank space on the airtime here because that's boring. So we'll copy this down. And there we got 2 more. There we go. 2 more. There we got it. Okay. So now let's copy this ending totals, which will just sum up and take the IRR, copying this up and copying that down. So there we have it. I'll call this the total, and this will be the IRR, the rate at which that sum of payments would be 0, making this black, white, and center. So there we have it. So obviously, if we sold it in the first few years, we'd have a negative cash flow. We'd have a net, not a benefit in just terms of straight cash. And then we'd start having a cash flow positive if we sold it in the 3rd year, it looks like, which is a little bit difficult to see, note over here because we have the totals on the right, but not too bad. And then we've got the rate of return, so we can then compare it. So if we look down here, down whatever year this is, probably the same 10 that I picked, we're going to go down here. This is year 13. So we've got the 80,000 that we put down up front if we look at it from a cash flows, and then we still paid more than we were paying for renting for years 1, 2, 3, 4, 5, 6, 7, 8, all the way out. And then this last year we got a bit benefit paying less than we would have for renting, given the fact that we assumed a 2% increase on the renting. And then we've got the inflow from the sale that we had net of the payments that we would make during that time frame. So if we then discounted that back using the internal rate of return, the rate at which that series of payments would be 0, we got the 6.97. So the 6.97, and you can see, the change that would happen if you were to hold the property in essence longer. So if we picked the item out here, we would then have the year 19, 80,000 down. We still paid more than what we would assume to be renting for all these years, and then it flips. So we got the positives on these years, and then we sell it for this amount. We got the net gain or inflow, positive flow of the cash, the 257,405. But of course, that's over a significant period of time now. The rate of return 7.75. So in other words, if I was to put this money, all this cash flow down somewhere else, what would be a comparable return generally to that? What would be the rate at which, if I discounted it back, this would be 0? We're looking at the 7.75 in that case. So that's going to be the general idea. And then, of course, once we have this set up, we can then make our adjustments to the data and then see what the changes will be over here. So let's format this. I'm going to do a little bit of formatting. I'm going to make this a little different, make it green to distinguish it. And so we'll make that green, and then we'll make this whole thing blue. So this whole thing we'll make blue and bordered, blue and border. And so there we have it. And so that looks good. And so, and we might do one more presentation just to look if we had changes on here and possibly prove, kind of give a better idea of one of these years. If we assume to sell it, in one of these years, what does this cash flow mean, or the IRR in essence mean? So we might do that one more time in a following presentations. Once you have the worksheet set up, however, then of course you can try to alter that or change it and put it to your own needs, whatever fits your own projections you're working on.